One of the most common mistakes that I see new dividend investors make is they look at an investment and see the high yield and automatically assume that it's a good investment. In today's video, I'm going to share with you what new dividend investors get wrong and how you can avoid this costly mistake. This mistake is not understanding how to invest based off of your personal time horizon. In this video, I'm going to share with you real examples and what to look out for so you don't make this costly mistake that a lot of new dividend investors make. And I'm very excited to share that this video is sponsored by Snowball Analytics, but more on them later. If you're new to my channel, my name is Jake. I retired from my 9-to-5 job in 2023 at the age of 37. And now I live off of my dividend portfolio and I make YouTube videos about dividend investing and the FIRE movement. I'm a pretty nerdy guy and I try not to take myself too seriously, so if you're new to the channel, welcome. To best understand how to invest based off of your investment time horizon and to avoid the mistakes that a lot of new dividend investors make, you have to understand the rule of 72. After we understand the rule of 72, I'm then going to take you through and show you some real life examples. Now, I've talked a lot about the rule of 72 on my channel. If you're a long-term subscriber of mine, you've heard me talk about this before, but in today's video, I'm going to take it a step further and I'm going to give you a few examples of what this will look like. So the rule of 72, if you're not familiar with this, is how quickly an investment will double. So let's take an example. If you have, let's say, $100 or $1,000 in your checking account, or a savings account. And let's say hypothetically that savings or checking account had a 1% interest rate. It would take you 72 years for that $100 or that $1,000 for that investment to double. Now, I wouldn't really consider that an investment if it's just in a savings account with this example of 1%, but that's the gist of how you want to look at this. Now, let's say, for example, you look at a short-term treasury bond, right? And that bond is yielding 4%. So if you put $100 in a bond ETF as an example, and you're getting a 4% return, well, it's going to take you 18 years for that $100 to double to $200. So every investment has an expected return over time. Now, this is where a lot of people get caught in between the weeds where they think, well, if past performance has been one thing, they just automatically assume that going forward. There are certain things that you can assume when you invest in the stock market. If you're invested into a savings account, you could reasonably assume a certain percentage. If you're investing in bonds, you can reasonably assume a certain percentage or return each year. If you're investing in the S&P 500, you're going to assume right around a 10% annualized return. Now this 10%, it could be up some years, it could be down some years, but annualized, you could reasonably assume about a 10%. So if you're investing in the S&P 500, you could reasonably assume that your money will double every 7 years. Now this is where it gets really interesting. You can invest into growth stocks, growth ETFs that have a higher return rate of maybe sometimes, 13%, 14% in some cases. And a lot of new investors, they look at some of these, new dividend ETFs, these cover call ETFs, and they see that they have a 20% dividend yield, a 30% dividend yield, and they immediately assume, okay, if I'm getting a 30% dividend yield or distribution, then I'm obviously going to get a much faster return. My investment will double quicker. Well, hold on a second, because the distribution is only part of the total return. Now, if you're not familiar with total returns, this is a very important concept that you have to understand, not only as a dividend investor, but as an investor in general. When you look at an investment, if the investment doesn't pay a dividend, well, the share price is your return. Now, if you invest into an investment like the S&P 500, which has a small dividend yield, well, the total return is the share price appreciation plus the dividend. So it's really important that we have that foundational understanding, because everything that I'm going to share going forward will not make sense unless you have that foundational understanding of total returns. Okay, so the total return, it's the share price plus the dividend or the distribution. That is the total return. Now you might be thinking here, well, why is the S&P 500 returning 10% a year? Is that reliable? Where am I getting that data point? Let me share with you really quick where I'm getting this data. So if you take a look at the S&P 500, the S&P 500 as we know it today, this index has existed since the 1950s, 1957. And since the inception of this index, the S&P 500, there's different ETFs of the S&P 500, right? You may have heard of SPY, VOO. These all track the benchmark, the index of the S&P 500, which was established in 1957 and annualized since 1957. The S&P 500 has returned 10% on average over that period of time. And once again, some years it's lower, some years it's higher, but annualized, averaged out, it's around 10%. So why is this important? This is really important, especially if you're a new dividend investor and you're looking at different investments to consider for your portfolio. If you're in your 20s, you're going to want to invest differently than maybe somebody who's in their 50s or 60s, right? This is what comes back to time horizon. And when I use the word time horizon as a dividend investor, I am specifically talking about when you plan on living off of your income that your portfolio generates, no longer contributing new money and no longer reinvesting the dividends. So instead of going to work and work at your 9-to-5 job, generating income through your active work, you're then passively living off of your investments. And that is what I'm talking about with understanding your time horizon as a dividend investor. When do you plan on no longer contributing new money and reinvesting the dividends and using that money to pay for your rent, to pay for your mortgage, to pay for the cost of eggs and everything else that's skyrocketed, these last couple of years. So with that understanding, how this works is, let's say, for example, you're a very risk-tolerant investor and you only really want to invest into bonds. Bonds are getting around a 4% return. So if you're in, let's say your early 30s and you plan on retiring in your 60s, if you're investing into bonds, your return is not, it's going to take you much longer to see your portfolio compound and grow over time. Now, let's say, for example, you're like, well, you know what? I want to go with the S&P 500. If you invest in the S&P 500, this is why everyone talks so much about the miracle of compound interest. When you have a long runway, when you're younger and you have a long-term time horizon, you want to focus on an investment that is going to have a higher rate of return over an extended period of time. You might be thinking, well, Jake, I'm a dividend investor. I want to kind of skip the line here and I want to cut some corners. Maybe there's an investment that I could take a look at that could maybe be better than other options out there. And a lot of new investors that I'm seeing are kind of brainwashed by the illusion of these covered call ETFs. Covered call ETFs they're a tool, right? It's an investment. And for the right person and the right time horizon, these are fantastic instruments or vehicles for you to invest in when you have a short-term time horizon. But if you have a long-term time horizon, this is the number one mistake that new dividend investors make, is they filter a list of all the dividend ETFs and stocks that they're interested in, and they go and they pick the one with the highest distribution, the highest yield. That is the mistake. And let me show you with real numbers why this is a mistake and what you should do instead. And to do that, let's hop on over to Snowball Analytics. And once again, this video is sponsored by Snowball Analytics. I'm a huge fan of them. I've been using them for quite a while. I get a lot of value out of their tool. Everything that you would want to understand about your dividend portfolio. The dividend yield, yield on cost, the dividend calendar, the dividend grades of your individual stocks. Everything is in this one tool. There's a lot of other tools out there that make you pay separately for different features and functionality that you as a dividend investor would be interested in. With Snowball Analytics, you're getting everything all in one place. So if you're interested in trying them out, you can use my link in the description below. Here for the next week, you will be able to get 30% off your subscription. And if you happen to watch this video after the promotion of 30% is off, you can use my code DGI to get the very best pricing on your subscription. Thank you so much, Snowball Analytics, for sponsoring this video. So I want to take just a second here very quickly and show you my portfolio. I've not shown it here recently in Snowball Analytics. If you watched my video a few weeks ago, I shared that I've did a major overhaul of my overall portfolio, and I've been condensing into these ETFs, SAHD, JEPI, JEPQ, and DJRO. I'm almost done. You'll notice here on the right that the allocations don't quite meet what I talked about in that last video, and the portfolio value is not quite where it should be. The reason why is I'm still rebalancing out of other positions into this portfolio. And I'm recording this video on March 7th. The market these last couple of weeks have been dipping quite a bit, and so I have been just loading up, just investing a bunch of money into JEPQ. So these last couple of days, I've seen JEPQ go down every single day. I'm just like, okay, I'll buy some more. So yeah, my portfolio, it looks very different than the last time I showed you in this, and it's not completely done. One thing that I've noticed that has spiked up, and it'll kind of adjust here these next couple of weeks, months, is my yield on cost has gone from 5.5 to just about 7%. So I've been buying a lot of JEPQ lately, and I'm really excited about it. If you watched that last video, my annual income was just around 50,000, and right now I'm over 80,000 projected, right, for the year annualized, and I'm not even done, finishing rebalancing. So I'm really excited about this. I think it's going to be really interesting. I'll share more updates on my portfolio, what I've got going on here down the road. Now I want to come back to this dilemma the new dividend investors have, is understanding how to invest based off of your investment time horizon. And I want to use a few use cases of how to explain this and how you should be looking at this. If you're a new dividend investor and you're in your early 20s, early 30s, and you know that you're going to be working for the next 10, 20, 30 years, you need to listen up and watch this video, and you need to understand what I'm going to share with you and watch the numbers and see how it all makes sense here. So what I'm going to do is I'm going to use a tool in Snowball Analytics. It's called Portfolio Lab. And what this is it allows you to backtest different strategies and portfolios. You can also backtest your own portfolio, but it helps you to run hypothetical scenarios. And what I'm going to do is I'm going to show you a few different examples. I'm going to show you 2 examples with covered call ETFs, and I'm going to show you 1 example of a blue chip dividend king dividend stock that's been growing its dividend for over 50 years. And we're going to take a look and see who should be investing, what you should be focusing on depending on your investment time horizon. The first one that I'm going to show you is XYLD. Now, this is a covered call ETF that's focused on the S&P 500 from Global X. Okay, and I want to show you, the reason why I'm using this one is it's been around for the longest. It's been around since 2016, and so there's a lot more data that we can capture with this example. Otherwise, I would have used JEPI or JEPQ. That's the reason why I'm using Global X. And they've been around since at least January 2016. Okay, now with this example, I'm not going to show any taxes right away. Okay, I am going to reinvest the dividends because we're focused on the total return in this example. Okay, I'm not going to do rebalancing, and I'm going to assume that this example is a portfolio of $100,000. It doesn't matter if it's $1,000, $100,000, $1 million, whatever it is, it's all relative to you. But for this example, I'm just going to use 100,000. So what we're going to do is we're going to take a look at what the returns are of the S&P 500 versus the Global X funds. And we're going to slice and dice it based off of the return and the dividend return. Okay. So first, what I want to show you is this right here. This is the total return of XYLD. This is a covered call ETF that has around a 8, 9, 10% dividend yield, depending on where it's trading at, versus the S&P 500. So I want to draw your attention to the top right here. You'll notice here the bubble here in blue. This is XYLD, and in orange, this is the S&P 500. So the S&P 500 on a total return basis has more than, it's more than doubled 100% that of XYLD. Now, you might be thinking to yourself, well, Jake, you're getting all those dividends. I mean, that's got to account for something. Well, yeah, it does account for something. In fact, if you look since the inception here in 2016, you've captured or gathered $110, almost $111,000 in dividends. Now you might be thinking to yourself, well, see, Jake, I told you that's the right, that's a good idea. Well, hold on. Your initial investment was $100,000. You've received $111,000 in dividends. That's not bad, all things considered. But when you compare it to just the underlying index of the S&P 500, it tells a completely different story, okay? And when you look back at that and you see that your total return has lagged the S&P 500, it kind of makes you rethink, well, those dividends are nice, but now I want to show you something that there's no free lunch. This is, remember with the filter that I had here, this is without a tax rate. Now, a lot of people have this in a Roth IRA. A lot of people don't have this in a Roth IRA. So they're paying taxes on these distributions. So there's 2 points that I want to make. The very first point is, regardless if you have it in a Roth IRA, a tax advantaged account, or a taxable account, you're still underperforming the index. So I know a lot of people start thinking, well, Jake, taxes, yeah. What if I have it in a Roth IRA? Well, it still doesn't replace the fact that you're greatly underperforming the overall market, okay? And this is important depending on your time horizon. I'm talking to somebody that's in their 20s or 30s. They have a long runway before they plan on living off of their portfolio. If you're in your 20s and 30s, what looks better to you? Would you rather underperform or, do you want to underperform the index just so that you can capture a little bit of dividend income along the way, which is a forced taxable event? And let me show you what this looks like when you're taxed on the distribution. Now, assuming that this is in a taxable account, which I believe the majority of new dividend investors, they have this in a taxable account because they're going to retire off of these cover call ETFs and they don't factor in the taxes. So what does this look like? So before, when you didn't have taxes, your total return was about $20,000 higher since 2016. So you've lost $20,000 just into taxes. This is just on your income. This is not considering the other taxes that you would pay against your W-2 income. Because when you have more income, it boosts your overall tax rate, so you pay more taxes on everything that you get. Does that make sense? So it's magnifying the tax implication even more than what you're seeing right here in practice. So once again, the major takeaway here is understanding your investment time horizon. Now I'm going to ask you the question. If you're 20 years old, you're 25, you're 30, or if maybe you're 45, and you know that you're not going to use the income of this investment for at least 5 years, 10 or 20 years, what makes more sense? Does it make more sense to invest into the underlying index, like the total US stock market or the S&P 500, or does it make more sense to capture a little bit of income along the way and pay a lot of taxes? I'll let you decide that for yourself. All I'm trying to do with this is give you the information and the facts so that you can make the decision for yourself. All right, now let's do another example of QYLD. Now, QYLD tracks the NASDAQ. This is the NASDAQ 100 index, and let's compare this with the NASDAQ itself. So we're going to take QYLD versus the NASDAQ. We're going to keep January 2016. We're going to do 0 taxes to begin with. Let's take a look and see what the return would have been. So with the NASDAQ QYLD, you would have gotten a higher total return, but the story is even more dramatic when you compare QYLD versus its underlying index, that being the NASDAQ. So when we look at the overall performance, your performance in QYLD versus the QQQ, it's more than 3x QYLD. Okay. Now you might be thinking to yourself, well, Jake, I'm getting all these nice dividends. Okay. Well, yeah, you did get a lot of nice dividends. You got, in fact, $150,000 worth of income which is taxed, by the way, which we'll look at it in a second. So of your total return, okay, your final balance is $204,000. Now stick with me here. Your initial investment was $100,000. You've received $150,000. Wait a second. Shouldn't that mean that your balance should be $250,000? The answer is no, you'd be wrong. The answer is $204,000 because the underlying investment, QYLD in this sense, the underlying in this sense, has eroded. The NAV, the share price of this investment has gone down. Yes, you've gotten a great amount in dividends, but that's where the return has come from. It's the dividends. You've sacrificed all of the growth potential for the dividend. Now, I want you to ask the question, before I ask that question, let's take a look at this really quick with the dividend, with the tax rate of 15%. What does that do to your return? And when we factor in taxes, you didn't even double your investment in over 10 years. When looking at the NASDAQ, it's over 4x, almost 5x since then. So I want to ask you the question, once again, if you're in your 20s or 30s, age is all relative here. If you have a long-term time horizon, are cover call ETFs the right investment for you? You might answer the question, well, Jake, I like the emotional benefit of, seeing that dividend hit my account. It makes me feel good. Well, if it makes you feel good, that's a valid thing. It's real. Emotions are real when it comes to investing. But that's all it is. It's your emotions. If you really want to build wealth and you want to do it in a way where you're going to set yourself up statistically and mathematically for the future, you have to understand how to invest based off of your investment time horizon. And ultimately, you have to understand what you are investing in. Okay. And so this is the mistake that new dividend investors make, is they just look at one piece of the puzzle of this total return. Oh, it's got a great dividend. Look at all of these dividends that we've been paid, right? They're only looking at that. They're not looking at what really is going to build their wealth. And I'll be honest, this is a mistake that I made early on. I wish that I would have understood this 10, 20 years ago. My net worth would look entirely different. My situation in life would be entirely different. But I didn't, and that's okay. That's life. But I'm hoping that if you're watching this video, hopefully you can learn from the facts and understand the reality, regardless of what somebody may be, pumping online or, telling you otherwise. It's important that you understand the facts. Now, here's a big disclaimer. I don't know what the future is going to hold. I don't know if the S&P 500, the NASDAQ are going to continue to go up in the future. I don't know. But the odds are greater, in my opinion, that you're going to underperform if you're investing into covered call ETFs if you have more than 5 years versus just holding the underlying index like the S&P 500 and the NASDAQ. And here's the beautiful thing that a lot of people don't think about, but what you could do is, what if you would have invested $100,000 back in 2016 into the NASDAQ, the actual index, and then in 10 years sold it, paid your capital gains, or if it was in a Roth IRA, even better, paid the taxes or not, depending on in which account you're holding it, and then you buy QYLD, JEPQ, cover call ETF, high dividend ETF, high dividend stock. This is the mistake that new dividend investors make. They don't understand the rule of 72. They don't understand how their investment, how the total return impacts how they're going to build wealth. And that's the mistake that new dividend investors make. All right, I want to show you one last quick example. I want to show you an example of a dividend king. And this is an example, I'm trying not to cherry pick, okay? Because Kimberly Clark has been roaring these last couple of months. It's actually almost at a 52-week high. So I'm not intentionally picking a stock that is down. This stock has actually been flat for the last 5 years, up and down. But to make this example valid and interesting, this stock is doing very well relative to the market right now. Okay, but I want to drive home even the importance of when zooming out and looking at this, the big picture. So let's take a look at this with the same parameters as before with the other two. We're going to compare this to the S&P 500. Is this the S&P 500? No, let's do it to the S&P 500. I don't want to do the NASDAQ. Let's do the S&P 500. And so if we're comparing Kimberly-Clark versus the S&P 500, you can see that the story that I'm telling here and what I'm depicting and showing you is it's consistent with individual stocks as well as ETFs. So if you're a new dividend investor and you're in your early 20s or 40s or however, and you have a 10, 20, 30-year time horizon, it's important to understand that you're looking at the total return, okay? Because what a lot of new dividend investors do is they go and they just look at this. This looks great, right? Yeah, this is cool. Since 2016, you've gotten $35,000 in dividends. That's cool. Good for you. Well, you've also paid taxes on all of those dividends, by the way. So let's take a look at this. If you would have invested into Kimberly-Clark, which is doing very well recently, right? You can see this big spike over here at the top, over there to the right. You'll notice here that Kimberly-Clark, it's a dividend king. It's greatly, greatly underperformed the S&P 500. So if you have a long-term time horizon, I ask you the question, is this a stock that you want to invest in if you have 20 years? Maybe it adds stability to your portfolio. I don't know. Maybe it's a stock that you add from day one, or maybe it's a stock that you consider adding maybe once you've already made your wealth, you've already accumulated wealth, and then maybe you invest into it later once you plan on retiring, right? It's not something that you have to invest in necessarily from day one if you have a long-term time horizon. Is this starting to make sense? You got the light bulb? That's it. Beautiful. Me too. All right, good. It is so important that you understand how to invest based off of your investment time horizon, and that you're not just going and watching videos online about the top 5 best stocks of March and April and just blindly investing into great dividend stocks, great dividend ETFs. It's important that you first understand, where are you headed? Where are you investing for? What time horizon are you in? Are you in your 20s? Do you plan on working for the next 40 years? Or are you someone who's maybe in their 60s, 65, looking to retire tomorrow? Or maybe you're 45 and you've invested into real estate, or you built a business, you plan on selling your business, and then you have a lump sum of money and you want to maybe invest into higher dividend stocks, because your time horizon in which, when you plan on living off of the income from your portfolio, because that's what dictates it, not your age, it's when you plan on living off the income. It's so important that you understand that. I made a video a couple of months ago titled The Dividend Growth Pyramid, where I walk you through this and help you understand how different investments grow at different rates. We talked about the rule of 72. This video is one of my favorite videos that I've created on my YouTube channel, and it's been one of the most successful. A ton of people have commented on this. And if you're a new dividend investor and you want to avoid this costly mistake of investing for the wrong time horizon, I'd highly encourage you to watch this video next. Thank you so much for watching, and I'll see everybody in next week's video.